Welcome back. Futures contracts this morning, and we are pretty close now to the open of regular market trading. The futures market all morning long has been pointing to significant gains at the open as investors are becoming more optimistic about U.S. and European trade talks and Japan's efforts to calm jittery bond markets. Let's talk about all of this and more with Sadiq Adatia, CIO, Chief Investment Officer at BMO Global Asset Management. Sadiq, thanks a lot for coming in.
Thanks for having me.
Are investors becoming complacent now on headlines that, while they may sound soothing about trade, certainly are not any indication of a permanent resolution on U.S.-China trade or U.S.-European trade?
Yeah, I think that's exactly right. I think people are happy that we're seeing calmer waters and that we're not getting through the 35, 40, 50% tariffs. But I think people are still forgetting that this is still a pause and not a permanent, stop on the tariff front. And we're still going to have tariffs. So that's still going to have an impact on consumers, on revenue, earnings, and eventually stock prices as well. So I do think people are getting a little too optimistic at the moment.
Right. Yeah, when you say we're still going to have tariffs, you're referring to that baseline of 10% that U.S. Political leaders continue to sketch out. That's material. That's material to economies and markets.
Yeah, and it'll be 10% for majority of countries. Other countries will even be higher than that, and certain sectors will be higher than that as well. And of course, you alluded to it earlier, U.S.-China, I don't think will be at 10%. I think it'll be a much higher number, but what that number eventually gets to is still up in the air.
How do investors evaluate things like fundamentals? I mean, in a more stable environment, investors look at corporate earnings, corporate guidance to assess stocks. That's becoming much more difficult now.
Yeah, what we're getting is a lot of CEOs giving kind of mixed outlooks. Either they're giving no outlook, first of all, or they're giving multiple scenarios depending on what tariffs actually eventually come through. That makes it very difficult to evaluate a stock, understand the risks, understand the growth coming through. So it's making it a little bit more, nervous for investors to figure out, where they want to invest. So what you're seeing is a bit more diversification across the board, moving away from just the U.S. to more international markets, moving away from the Max 7 to some of the more diversified names out there. I think that's a trend you're going to continue to see going forward. However, I do think still that the underlying economies are still very strong. I think markets still go higher from here. I just think, given the movement we've seen at this point in time, probably prudent take some profits here and just reevaluate a little bit. And then again, understand that the uncertainty is still out there. It's not a for sure story about where tariffs are going to lie or that Trump's finished with all the pressure on markets or countries and then tariffs as well.
So how do we reconcile those two outlooks? You think markets will go higher from here, and the Canadian market is at its highest point ever if you consider the S&P TSX composite to be a relevant indicator. It's our national benchmark. The S&P 500 not too far off its record high. So you believe markets will go higher, but perhaps this is the right time to take profit as well.
Yeah, I mean, if you think through, the underlying economies before we even started the tariff situation was quite strong in the U.S. in particular. Companies were great earnings, momentum was there, consumer was strong as well. So that part of the economy was in really, really good shape. The tariff situation just added some, uncertainty there. It probably means that the consumers can tighten up a little bit, maybe adjust their spending patterns, but that doesn't mean they're going to stop spending. Unemployment is still relatively low, and that means that consumers are going to help drive, revenues much higher and see markets go higher from here. However, just in the short term, I think, we've seen markets react quite quickly to information. We see today's news on the European side, markets move up. But any moment in time, we can see the opposite occur, right? Trump can come up with a policy that people don't like. He can go after a certain country or sector. Markets can react quite negatively to that. I also think once we get to the close to the 90-day, pause date, that we could still see more uncertainty popping up there, and particularly with China and the U.S., because both sides I don't think are going to give in pretty easily, and that's going to keep markets quite volatile. So I think right now, taking some profits, not being significantly underweight equities, but just taking some profits here, I think is a prudent thing to do. In terms of geographies, you remain most constructive on Europe, Asia, and the Far East, the so-called EFI stocks. That's correct. I think that's an area that was undervalued, high yields there coming through. I think actually the Trump situation actually has helped them from the standpoint of the debt brake rule coming off in Germany, more defense spending going on. So you're seeing a bit of a lift coming there, bit more optimism. Money that's moved a little bit away from the U.S. is coming to Europe as well. So we do like that momentum trade there. but I don't think it's the same growth as the U.S. still. So I do want to highlight that part of it. We're not exceptionally bullish. We're just slightly bullish on that front, and we've taken that money away from the U.S. So that's where it's funding from. And then when we think about broader emerging markets, I think the story to us is that China's a good long-term story. Again, we want to see how this tariff situation plays out before we get too overly optimistic there.
Most of our viewers who, if they wanted to invest in EFI stocks, Europe, Asia, Far East, would probably do so by way of index tracking ETFs. You're constructive on that, on the indices, on that way of investing in those markets?
Yeah, I think it's an easy way to get invested in those markets, get the exposure, low cost, great way to do that. But there's also additional value there from active management that you can still take on advantage of in areas like financials, for instance, and even potentially other segments of the market as well.
Okay, the Canadian stock market at a record high. You're not you're neutral, are you?
We're neutral on that. I think the underlying economy is not necessarily strong, but I do think that's going to cause the Bank of Canada to cut rates a little faster to give some support there. I think you'll see some stimulus there. I like the fact that we're not seeing a lot of tension between the U.S. and Canada. Carney's done a good job of calming the waters there. I think that's a good sign of things to come. And I think, when we look out longer term, we still have to remember that the U.S. is going to be a stronger economy. Canada will still benefit off that as well. So that gives us a kind of a neutral tally on Canada. We used to be underweight, so this is a little bit of an upgrade from that perspective. But we'll see how the year plays out from an underlying economic data perspective.
What's your take on the Canadian dollar and where it goes from here? If the Bank of Canada is poised to cut rates, as many expect it is, what happens to the Canadian dollar?
Yeah, I'm proud of our call here. We early in the year, we had one of the few calls to say that Canadian dollar would actually appreciate versus the U.S. dollar, post discussions on the tariff side, and that's kind of what's happened. I think the Canadian dollar will continue to do a little bit better than the U.S. in the short term. As we think about where things are going on, the risk aversion trade is kind of off a little bit at the moment. That should favor other currencies. I think generally when you look at what trade is going to do, it's going to find new partners for other countries around the world. That potentially could put a little pressure on the U.S. dollar as well. And I think the Fed will also start cutting rates as well. So I do think that Canadian dollar has room to go higher from here. Not significantly by any means, because I still think people still look at the U.S. as a reserve currency. But probably looking for other alternatives as well along the way.
Okay, let's finish with gold. What has happened to the rally in gold? It's stalled for a couple of months at least.
Yeah, I think that's because of the fact that we are seeing some bounce back on the markets. We're seeing a little better, calmer waters on the tariff front. I still like gold on the uncertainty play. It's done really well for us. We've owned it since 2023. One of our best trades coming in. I think it holds a good value from a hedging perspective. If you're worried about the U.S. dollar another way, if you're worried about potential inflation from a tariff side, I think it plays all three really, really well. On top of that, you're seeing a lot more demand for gold as well.
Sadiq, thanks a lot as always.
Thanks for having me.
Sadiq Adatia, CIO, Chief Investment Officer at BMO Global Asset Management. Coming up,